An income statement, you need to memorize two equations here to really understand what the income statement's trying to do. Firstly, your sales minus the cost of goods sold, I'm going to explain that in a sec, equals your gross profit. Once you've got your gross profit, if you then minus expenses from there, you end up with your net profit. So the end of the first equation is the beginning of that second equation. Sales minus COGS is your gross profit. Now once you've got that, you minus expenses from there to get your net profit. The way that it looks is you're going to come up with two main equations on the side here. If we start with sales at the top minus your COGS equals your gross profit. So we've got a little loop around there that shows that the sales minus COGS equals gross profit, and that's the first equation there. Once you've got that gross profit, you then subtract the expenses, and that is going to equal your net profit, right? So that's how it's going to look. That's how it's going to be set out. But again, it's not going to have the colors. The colors are there to explain to you which ones are usually positive figures and which ones you're subtracting, right? So the sales right at the top, you're starting with those sales, and then you're subtracting the COGS and you're subtracting the expenses, but you do have the green one in the middle, that gross profit, which hopefully is going to be a positive number, where you kind of have a subtotal of how you've gone. And I'm going to explain the reason for that now. The COGS on the side there, COGS are costs directly involved in production. So it's cost of goods sold. It's only the things directly involved in production. So raw materials, ingredients, things like that, that are directly involved in the production of the product. The gross profit, the reason we have this gross profit, subtotal here, is it lets you know if your production costs are too high. If your sales minus your cost of goods sold, right? If the stock that you ended up selling or the ingredients that you used, if you're a restaurant or something, if they've cost you so much that your gross profit is negative or not very high, it lets you know straight away, hey, it's not the electricity bill, it's not the advertising costs, it's the actual production costs themselves. So we need to work on those. After you've got the gross profit, we subtract the expenses. These are anything that costs a business money other than the actual cost of goods sold. The three categories that you need to memorize are selling expenses, administrative expenses, and financial expenses. And you really don't care personally, what they are, but you do need to memorize them because they are the different categories that are counted as expenses. So once you've done gross profit minus all the other expenses, your net profit will tell you if your other expenses are too high. So that's the whole point. You have that gross profit in the middle and the net profit at the end, and you can compare them and say, okay, where is the problem? I'm a financial manager. I'm trying to solve this issue. Why are we losing money, or why are we not making the profits? Let's have a look at our cost of goods sold. What's our net profit? 40%? That's great. That's a pretty high net gross profit. All right, let's look at our expenses. Oh, they take away another 35%, so our net profit is only 5%. All right, let's look at our expenses. And then you split them into those different categories. Maybe we're spending too much on selling. Maybe we're spending too much on administrative expenses. And that's the job of a financial manager. A good financial manager should be able to see those areas and where there are problems. So we then plug numbers in there, just so you know what the numbers actually look like. What we have up the top there are the subtotals and the totals, because the subtotals, in accounting usually are down the left-hand side and the totals on the right-hand side. So when it comes to your operating income or your sales, the subtotal of sales is $600,000. You might make money from other parts of your operations rather than just the sales themselves, and those can go on there. But as long as you know that basically at the top we're talking about sales. If the subtotal is 600,000 and there's nothing else, the total is going to be 600,000. Cost of goods sold. Usually it says up the top here, less cost of goods sold. So we're talking about the opening inventory purchases minus the closing inventory. So what did we have in terms of stock at the start of the year? What did we end up buying over the year? And then we subtract whatever we had at the end of the year. I'm going to explain that again in a second. So the total there, after you take 340 minus 60, is 280,000. So your gross profit is just going to be the top one minus the second one. 600 minus 280 equals $320,000. Then you start looking at expenses. So selling expenses are things like advertising, right? So let's say they're $40,000. Administrative expenses are things like the phone and the rent and all that sort of stuff. Let's say that's $120,000. And the financial expenses are things like loan repayments. Let's say they total $60,000. So you've got this gross profit of 320 grand, and then you've subtracted expenses of 220 grand. So obviously your net profit before you end up getting taxed is $100,000. So you made $600,000 in sales, and your net profit in the end, the amount that's going to the owners after it gets taxed, is $100,000. Now there are individual calculations within this income statement that I just kind of glossed over. So let's use a simpler example. Let's say the sales are $1,000, right? Or it could be like 1,000,000 or whatever. But let's say it's 1,000 just for the sake of making it nice and simple. Below the sales, you've got your cost of goods sold. So we start with that opening stock, that OS. Let's say you started the year, July 1, you counted all the stock that you've got. You've got $560 worth of stock just waiting to be sold. During the year, you buy another $300 worth of stock, right? But you need to remember, and it's something that students often forget, that you did sell some things, right? So you need to then, on June 30th the next year, count your closing stock. How much do we have left? So we started with 560. We got another $300 worth of stock. But how much are we left with, right? And that kind of tells you how much you sold during the year. So you subtract that. So let's say your cost of goods sold ends up being $700. So your gross profit is going to be your sales minus your COGS, which is 1,000 minus that 700 that I just showed you, which is equal to $300. Then you start taking out expenses. Let's say for this business, it's a tiny, it could be 30 million, doesn't really matter. Expenses, financial expenses, 30 bucks, administration, 50, sales, advertising, 70. Those are your three categories of expenses. So now that you've done that, you do your gross profit minus expenses, which is $300, that was your gross profit, minus all those expenses added up. Let's say they add up to 150 bucks, 150 million. So your net profit in the end is going to be $150 or 150,000 or 150 million. Right? Those are the things that you need to be able to do because you can, because you do have to know this in the syllabus, you probably can get asked a question, what are the missing figures, and you do need to be able to do it, which also means that you need a calculator, as I've said before. So you can see your sales minus your COGS equals your gross profit, and then minus your expenses equals your net profit, right? So that's what an income statement looks like. Now, it's not actually going to have all those colors. It's not going to be that simple. But usually the way of telling if it's an income statement is you look for sales at the top, or operating income or sales at the top, and then things getting subtracted below there.